Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 255, Inflation and Your Portfolio. Corey, welcome back to the show.
Jake, thank you for having me. I'm excited to be here.
Yeah, we've been having some technical difficulties, so hopefully this show's not too glitchy. I do apologize if things are getting a little glitchy for our audience on the video, but the audio content should be crystal clear. Corey, got anything fun going on in your life?
Not anything too fun and exciting. I just finished a really good book, Jake. I think I've maybe talked about it on this podcast before, but the book was called Devil Take the Hindmost, and the book is about a history of financial speculation and basically bubbles that have occurred in the market. I've talked about this before because it was a labor of love to get through this book, and eventually it just became a book that I only read on airplanes. But I ultimately got all the way through it. It was really, really good to see how human behavior has been so consistent for centuries.
Awesome. Good for
How
you.
about you?
You know, I'm a really big fan of that America's Got Talent.
Really?
You watch that show?
No, I don't think I've ever watched it.
What? I think they're on their 18th season, man. It's pretty good.
What would you do if you went on America's Got Talent? What's yours?
I don't know. I'd be a financial advisor.
Give financial advice? Good.
But this isn't your St. Louis talent show, Corey. These are some crazy talented people. So it's been pretty fun. I like it. I think it's entertaining. It's good to watch.
Good.
So I watched that last night with Rachel, and you know, she claims she doesn't like it, but then I'll catch her because I'll turn it on. I'll catch her watching it more intently than me. So I think she's a fan. She just doesn't admit to it.
Yeah. Next time I see Rachel, I'll ask her about the most recent season of America's Got Talent. I'll check in with her on it. I'll take the temperature check.
Yeah. See what she says. I bet. Let's see if she owns up to her fandom.
All right.
All right. For today's topic, though, we do want to talk about inflation in your portfolio. Inflation's been a hot topic over the last year or two, Corey, and I think it's important that we discuss it with our audience. So first, this is a quick definition of inflation. It's basically a general increase in the price of goods and services within an economy over a given period of time. Basically, it erodes purchasing power, or in plain English, it makes our dollars worth less. Did I cover all that, Corey, as far as what inflation is?
Yep. Yes, you did.
And, you know, a lot of advisors will use examples like the price of a stamp. If you go back through history, you know, prices of homes, of cars, it's just what happens. And ultimately, if you have more people on earth consuming more goods and services, typically over time, prices of those goods and services does increase. Now, there are three key factors, Corey, that contribute to inflation. So why don't you kick us off with number one?
The first one is demand. This one's really relevant, especially after the last few years. Demand for goods and services. When there is more demand than there is supply, businesses raise prices. Consumers are willing to pay more given their demand, and that inherently creates inflation. And it's a lot of what we experienced the last few years.
Right. So, you know, classic example of this would be used cars. If you remember, during COVID, there was supply chain issues, and used cars actually were one of the best performing asset classes, which I don't really call it an asset class, but you can. And they went up in value during the COVID pandemic because it was hard to find a car. So demand was still there. People were still driving around, and there wasn't supply. And so the price of those used cars actually went up. The second factor to inflation, Corey, is the cost of producing goods and services. So that can come in the form of employers paying their employees higher wages, raw material costs, right? So literally the materials to build products, or just taxes. All that can lead to businesses having to raise their prices which ultimately leads into inflation. And I've got a personal example of this. Rachel and I own a magazine, and the cost of paper, Corey, has gone up ridiculously. And so that has certainly eroded our margins. And again, Rachel runs the company, but it's made it far more difficult for her to turn a profit when the paper prices are way higher than they were a few years ago. So that happens. It's inflation. Do you have any other examples of cost of production going up?
I think you've touched on them.
Good. What's the third one then?
Monetary factors or monetary policy, like an increase in the money supply, for example, by a central bank, the Federal Reserve here in the United States. When there's more money that's circulating in the system, there's more purchasing power, which can drive up prices.
Yeah, what's a good example of that?
The last few years, I would say ultimately the last few years we experienced disruptions to the supply chain, and demand was increased due to the money supply being created. There was additional dollars that were being created. There's a lot of stimulus effect in the economy. And that is a perfect example, I think, of monetary policy ultimately leading and driving inflation.
Yeah, and I would say PPP money is an example of inflation. Or didn't the government, based on your income threshold, give everybody stimulus checks during COVID? They did that charitable
stimulus
gifting, right? So all that stimulus drives up because there's more money flowing in the system. So there's more ability for people to spend money on things, and that drives up the prices.
Can I ask you a question, Jake?
Of course.
What we just highlighted 3 factors. In your opinion, is there one of them that drives all of this more than any other one?
Thank you for asking that, actually. And we didn't prepare for that one. So I like it.
Didn't.
I think the number one cause of inflation personally is human behavior or psychology. So us as citizens, if we are willing and able to pay these higher prices and continue to do it, it's a snowball effect. But if citizens stop overpaying for cars or whatever, then that can calm inflation. So I really think the number one driver maybe is not in, kind of these core definitions that we've thrown out there, or the factors. I think it's human behavior. And so I think it's psychology. So think about it. Remember when COVID hit, toilet paper, you couldn't find toilet paper anywhere.
I know.
That's because of human behavior was causing that, and psychology. And so I think that is really the cause of inflation. I think monetary policy does obviously play a role, but I think if consumers stop paying for those higher prices, then ultimately prices will come down. But that's easy. That's hard to control, right? How are you going to control millions of people's behavior? That's hard to do.
That's interesting. That's a good perspective, Jake. While you were explaining that though, my thinking behind it though was what drives the human behavior.
Fear and greed.
Part of that is being right. But I mean, I guess a different way for me to put it would be that, if we don't experience inflation all of the time because of human behavior, and there's certain instances where we experience it much more like we have the last few years, that leads me to draw the conclusion that is up for discussion that ultimately monetary policy can drive human behavior. People pay more money, are willing to pay more money for more stuff if they are getting a check in the mail. If somebody's giving them the money to spend, chicken and the egg.
Yeah, I could see that. But, a lot of those people saved that stimulus money and they didn't spend it. So
True.
I think you're right.
True.
I see you're right. Monetary policy certainly can influence behavior, but I don't think it's the end all be all. I think in the end, it comes down to the behavior and fear. And like I mentioned just now, fear and greed, I think, drives human behavior. Unfortunately, if you're scared, Corey, you're not going to have toilet paper. You're going to go buy toilet paper.
Buy all the toilet paper I can and pay whatever
Right.
price, right? Yeah. Yeah.
Or
right.
If you think toilet paper is
disagree.
on sale, you might get a little greedy and buy, a couple packages instead of just one.
True.
So, we do a lot of talking our clients off the ledge with fear and greed as far as their investment portfolios are concerned. And we're going to talk about that today with inflation in your portfolio. But I think that does drive human behavior also, and spending. So yeah, you're right. The government can prime the pump, But ultimately, I think fear and greed drives behavior. I think it just does.
Yeah, it's a very human phenomenon, which makes sense. Of course it is. Of course it is.
Now, to our point, though, there are some good aspects of inflation, and kind of to keep our conversation going here. But number one is it encourages people to invest and to spend their money rather than just to sit on your cash. Basically, you want to put it to work before the price of things go up in value. So a good example of this is the housing market. I mean, who knew the housing market, even through the pandemic and everything going on, that houses are still going up, even through higher rates, housing prices are still higher than they were. So it actually pays for someone to buy a house 5 years ago or 4 years ago versus waiting, thinking that home prices were going to go down. Same thing with the stock market. Again, we don't know in any given day or year if the market's going to go up or down, but it's had a heck of a run if you look back the last 5 years. So again, that encourages. So when you have inflation, encourages people to go do things because they have this FOMO or this fear of missing out, that if they wait, it's just going to cost them more later. What's another good factor of inflation?
It reduces the quote unquote real value of debt. So the idea is, again, exactly to the point that you made at the beginning of the show, Jake, if purchasing power gets diminished, right? If the dollar doesn't go as far, but you've ultimately borrowed money, the idea is you, in a lot of ways, sort of inflate that debt away over time, because it actually reduces the real value of the debt.
Yeah, we use the term real for adjusted for inflation returns. So that's a really good point, Corey, that if you have a mortgage at 3% and now a mortgage is 6%, well, it's easier now for you to pay back that mortgage technically because you don't have to borrow money at 6%. So it's good to pay off existing debt. Now, there are bad things to inflation, though. You can buy less with the dollars you have, right? So if, toilet paper was $7, now it might be $10, right? So you don't get to consume as much money you have because the cost of all these goods and services have increased. What's another bad effect of inflation, Corey?
Uncertainty. It causes people to freeze up. It makes it more difficult for people to just make decisions, frankly, about, do I spend now? Do I spend later? Do I invest now? Do I invest later? It's something that can ultimately just, freeze people up.
Right. And I talk about this all the time with our clients that are shopping for homes. Jake, should I wait for the house, the home prices to come down? And I've been telling them, no. I mean, they could go down, but ultimately we don't think a home should necessarily be always considered an investment. We think a home is a place for you to live and feel safe and make memories. And so, yes, if you have to, what you think you're overpaying for today, hopefully that asset appreciates over time. But, people are frozen right now with home buying because they're so expensive and now rates are higher. But, a lot of the mortgage brokers and real estate agents will tell you got to just get in the game because prices may continue to go up and you may have to pay even more by waiting. The last piece here is that income distribution, there's a disparity. So people on a fixed income, so let's say you have a fixed pension, Corey, and you're getting $3,000, $4,000, $5,000 a month, whatever that may be, and it does not increase for inflation. That can be a bad effect on it. That could erode away your purchasing power because things are costing more, but you're not making any more. Now, the good news is Social Security generally has cost of living adjustments that have been pretty substantial as of late. But what I'm talking about is people just literally have a fixed income and they don't get any raises in their pay. So good. So we talked about kind of what inflation is, the good effects, the bad effects, the key factors. But to bring it back here full circle with your portfolio, I think the key here is to invest in companies that will benefit from rising inflation or that also aren't prone to inflation and have inflation risk. And so that's what our investment strategy is basically our teams will take that macro look at inflation and adjust the portfolio accordingly. And we want to be in companies that we think will be able to handle this cause and effect relationship with inflation and not be overly exposed. Now, we don't want to do this, Corey, at losing diversification. So we don't want to go shift all one way or all the other. But overall, we understand that we're in an inflationary time frame, and we just want to make smart decisions based on the companies that we're buying and selling for our clients. Did you want to say something on that?
I think that is a good explanation of it and really what it means for the portfolio. The point that I would just simply reiterate, though, is that inflation is not inherently bad for the market. It's not inherently bad for companies. It can have a very different effect on different companies in different ways. But I really think even the last few years, we've seen a lot of swings in the market, whether we're looking at indexes or individual companies. But really, when we take it back to the most fundamental level and think about buying stocks, investing in companies for our clients, we're ultimately acquiring ownership in that company. Those companies are led by humans, by management teams, some of whom have done a better job than others, adjusting to the environment. So I think what just the last few years is a great example of seeing the market has rewarded some companies whose management teams have acted with discipline and adapted to the environment, and the market has punished management teams in other companies that haven't done that.
Right. And it's our job as the investment management team, because again, we do that all in-house at Falcon Wealth Advisors, to make sure that we're researching that and putting our clients' capital to work in those good areas that we think are good areas. Now, also talking about your portfolio, you don't want to ignore your bonds. So during this high inflation period and the fact that the Fed has continued to raise interest rates, we feel it's a tremendous opportunity to add bonds to your portfolio where appropriate. So as bonds are maturing for our clients or they have cash come available to them, we're going in there and we're buying bonds that are paying much higher interest than they were just a few years ago. And so you definitely don't want to ignore that bond portfolio during this type of environment, because if the Fed goes and turns around and starts lowering interest rates next year, and you have bonds that are locked in 3, 4, 5 years out, paying much higher interest, that could be a home run for you and your bond portfolio. So again, you definitely don't want to ignore the bond portfolio. Our traders are watching that as well, and they're making sure that we're buying what we consider investment grade bonds that are paying hopefully much higher yields than investment grade bonds were 2 or 3 years ago. So it's a great opportunity in the bond market right now.
Yeah, I think it is. I didn't mention this earlier, Jake, but as far as the inflation, at least the headline consumer price index, which is the way that the Bureau of Labor Statistics measures inflation, inflation peaked on a year-over-year basis. Inflation peaked in June of 2022, and it was just over 9%. And the inflation data that was reported this month showed that inflation year over year is just below 3% now. So we've seen a meaningful move lower in inflation. And I think you brought up a great point about the bond piece, because if we just think about the yield curve, I know it's very technical, but if we buy bonds in 1 year, 5 years, 10 years, in theory, the further out you're willing to go, if you're lending money to a company buying a bond, the more interest you should earn. But the yield curve, interestingly, right now, short-term bonds are paying much higher interest rates than intermediate to longer-term bonds, which in a lot of ways is inherently the market pricing in the expectation that interest rates are not going to stay where they're at for the next 10 years. So to your point, yes, I understand the desire, the temptation almost in a way to say, I'm just going to buy a bunch of bonds that mature in a year because they're going to pay me 5%, right? Not bad. I get it. However, the bond market and the yield curve is telling us that inflation is not being priced in as a multi-decade event. It's not even really being priced in as a multi-year event. So exactly to your point, taking advantage of locking in the current interest rates, particularly if rates fall and inflation continues to decline, makes a lot of sense. And it's a great opportunity for people to do just that.
Right, right. And that's awesome that inflation. So again, the central bank, that's their job, is they're trying to balance inflation and support a healthy economy and have stability. So they've taken it from 9% all the way down to 3%, and their target's around 2%. So they've made a ton of progress. To their fault, they waited too long to raise rates, and so that's why we had this issue to begin with. But the good news is they have been vigilant, Corey, and they have been aggressive, and it's working its way back into the system. So again, we expect them to raise rates 1 or 2 more times probably this year, and then hopefully maybe they get to lower them next year. But regardless, we're looking for that stability, and we're looking to take advantage of the environment, lock in some good rates where we can, invest in good stocks where we can, and continue to manage our clients' portfolios as fiduciaries. And so that's good. So again, I know that's all the time that we have for today. Corey, any parting comments on inflation? Hopefully this has been educational for our clients, because you hear inflation a lot in the news, but I don't think advisors really break it down the way that we just have, as far as in plain English of how it exactly works.
Yeah, I think my final parting thoughts, Jake, one, as you pointed out, it could be a great opportunity opportunity, I think, frankly, for people, maybe if they have idle cash to put to work because interest rates are a lot higher now. I think it's a great opportunity to do just that, but also just recognize how we talk about almost every week on this show, Jake. And I know that you and I talk about every week, we talk about this every week with clients, but when we think about the financial planning, the investment management, everything that we're doing, there's periods where inflation's high, there's periods where inflation's low, just like, presidents, right? In the White House and Congress, that everything ebbs and flows and nothing lasts forever. And our job is to ensure that we are navigating those environments for our clients. And as you've described here, Jake, the beauty of it is we have the ability to do that. But just recognize that nothing lasts forever. The environment that we, just a few years ago, we all thought we were never going to leave our houses again, right? And now inflation's up because the demand is so high. People want to go places and do things. So just because we find ourselves in a certain economic environment does not mean that people should drastically change everything that they're doing with the expectation that this will be the reality for the next 30 years.
Yeah, good point. Yeah, and that's why you got to roll with it. And again, I don't want clients thinking that they can go in and micromanage their portfolio. We should just get rid of all the stocks that aren't doing well or the stocks that aren't pro-inflation. Like I mentioned already in this episode, is you want to stay diversified. We are just doing the research to make sure that we feel that we're well positioned. So that's a good point, Corey. You don't want to blow up your portfolio, but you want to be aware of what's going on at a macro level, and then rely on your friends at Falcon Wealth Advisors to make good investment decisions and explain them to you. And that's what we're here for. So thank you again, Corey, for joining him on today's episode. Thank you all for tuning in. Please like, subscribe, and share our content. And we hope all of you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.